Charlie made a very good point there about how managers could do better if they understood investments. I find it absolutely fascinating, and I've seen this throughout my life. I've seen it close up. I will have friends who are CEOs of companies, and they'll have somebody else handle their money. If you say to them, should you buy Coca-Cola or Gillette or something like that, they'll say, that's much too tough. I don't understand that sort of thing. What do I know about investing? And then some investment banker will walk in the next day with the idea they buy a $3 billion company, which is just buying a lot of shares of stock of one company. And they'll run through some little 2-hour presentation and turn it over to a strategic planning group and think that they are then the ones that should make that decision as to whether to buy multi-billion-dollar businesses when they really don't feel they're qualified to make $10,000 decisions with their own money. And it's extraordinary what you see in corporate America in the acquisition activity. It's a little like they say about making sausage and making laws. It's better unobserved. Charlie, you have any further thoughts on that? You've seen a lot of it with me.
Well, I do think that the present era has no comparable precedent in the past history of capitalism. I think we have a higher percentage of attention of our intelligent classes into buying little pieces of paper and trying to get rich doing it, and in promotional activities with big profit sharing fees. I can recall no past era which had a similar concentration of this type of activity. Can you, Warren?
No, but I think you would say probably too that when we've seen sort of baby versions of this, something subsequently happened that
oh yes, if you want to talk about what are the future implications, a lot that I see now kind of reminds me of Sodom and Gomorrah. And
we weren't there, incidentally. I mean,
no, but there's a published account. And I think when you get as much sort of regrettable activity going on and sort of feeding on itself in frenzies of envy and imitation, that it has happened in the past that there came bad consequences.
On that cheery note, we'll move to number 5.
Apart from the catastrophic insurance events or Armageddon scenarios that you've been talking about earlier, in relation to the operations of Berkshire Hathaway, what are your greatest fears?
Well, the greatest, I would say, we don't worry about the economics of the businesses we have. We've got a very diverse group. By and large, they're very good businesses. By and large, they're run by some of the best managers in the country. But we worry about something going wrong. I mean, you heard about the Solomon thing in the movie, and I mean, we've got 180,000 people out there, and I'll guarantee you something is going wrong someplace as we talk. That's just the nature of it. But what you hope is that it's relatively unimportant, or that we catch it, but that's, that is something that we know will happen. We try to have a culture that minimizes that, and I think we do have a culture that minimizes that. It's very important in our view to have the right incentives, and many places we think have incentives that aren't so good. I mean, when I get on an airplane and we own the company like NetJets, the last thing in the world I want to tell the pilot is that I'm running late and I hope we can get to New York a little faster. I mean, that is dumb to incent a pilot who may be worried that, somehow you affect his job or something, to get in a hurry about the takeoff or the checklist or whatever it may be. And companies do that time after time in their compensation plans or things that they incent people, in our view at least, to some of the wrong things. That doesn't mean nothing wrong will happen under any circumstances, but you should not have a system that causes people to, for example, worry about quarterly earnings. none of our our managers do not submit budgets into almost. I have no idea what we're going to earn next quarter, and I have no implicit body language out there or anything of the sort to our managers that I'm hoping to earn X dollars per share in the quarter, because in the insurance business particularly, you can report any numbers basically that you want to if you write long tail business for a short period of time. And we've got 45 billion of loss reserves. Well, who knows whether the right figure is 45 billion or 46 or 44. And if the desire is to report some given number in a given quarter, instead of saying 45 billion, you say 44.75 billion or something of the sort. So we have no incentives in terms of how people are paid, or in terms of the fact they just don't want to let me down. Let's assume at the start of the year I asked everybody to submit budgets, and then I went out in Wall Street and preached a bunch of numbers. Even if their compensation didn't depend on it, the managers would feel, we don't want to let Warren down on this, so we'll take an optimistic view of reserves. And that's easy to do at the end of the quarter, and we won't let him down, and then he won't look like a jerk in front of Wall Street. So we try to avoid that sort of thing. But even then, that is what we worry about. We don't worry about this place making money. I mean, we'll make money, and if we don't, it's my fault. And that's not the problem. The problem right now, in addition to the one we just talked about, the problem is deploying capital, and that's my job too. And I haven't done a very good job of that recently, but with a little luck, we will, in a different kind of market situation, we will get a chance to do that. Charlie?
Yeah, well, if you stop to think about it, the history of much of which we don't like in modern corporate capitalism comes from an unreasonable expectation communicated from headquarters that earnings have to go up with no volatility and great regularity, corporate earnings, I mean. That kind of an expectation from headquarters is not just the kissing cousin of evil, it's the blood brother of evil. And we just don't need that blood brother in our headquarters.
Businesses do not meet expectations quarter after quarter and year after year. It just isn't in the nature of running businesses. And in our view, people that predict precisely what the future will be are either kidding investors, or they're kidding themselves, or they're kidding both. And Charlie and I have been around cultures, sometimes on the board, where the ego of the CEO became very involved in meeting predictions which were impossible really over time. And everybody in the organization knew, because they were very public about it, what these predictions were, and they knew that their CEO was going to look bad if they weren't met. And that can lead to a lot of bad things. You get enough bad things anyway. I mean, but setting up a system that either exerts financial or psychological pressure on the people around you to do things that they probably really don't even want to do in order to avoid disappointing you. I mean, I just think that it's a terrible mistake, and we'll try to avoid it.
Do you think an individual or a business owner here in the U.S. should be concerned about the purchasing power of his future dollar earnings or savings and diversify his or her investments in non-dollar based securities?
I think it's very tough for individuals to either select individual stocks, select individual times to enter the market, select currencies. I mean, I think that's a game that they tend to get interested in at the wrong time. There's some adverse selection in terms of when people who do not follow stocks carefully get interested in stocks. And I think that the best investment you can have for most people is in your own abilities. I mean, when I talk to students, I would pay a student. In many cases, I would be glad to pay them $100,000 for cash up front for for 10% of all their future earnings. So if I'm willing to pay $100,000 for 10% of them, I'm valuing the whole person at $1 million, just capital value standing there in front of me. And anything you do to develop your own abilities is probably going to be, or your own business is probably going to be more productive for you than starting to think about individually making commitments into foreign exchange. If you have a good business in this country earning money in dollars, you'll do okay. I mean, you may live in a world 20 years from now where a couple percent of the GDP is going to service the debts and the ownership that we've created now by running these deficits. But you'll do fine in America, so I wouldn't worry about that much. Charlie?
Well, if you look at Berkshire, you will find that it really doesn't do much of conventional asset allocation to categories. We are looking for opportunities, and we don't much care what category they're in. And we certainly don't want to have our search for opportunities governed by some predetermined artificial bunch of categories. In this sense, we're totally out of step with modern investment management, but we think they're wrong.
Yeah. And incidentally, we have 80% of our money or more, well over 80%, tied to this country and to the dollar. So it's not like, we've left the country or anything of the sort.
But when have you done a big asset allocation strategy?
Never.
Yeah.
Yeah. We end up with peculiar asset mixes. I mean, if the junk bond thing had gone on a little longer, instead of having $7 billion in there, we might have had $30 billion in. But we were doing that simply based on the fact that it was screaming at us. And we do the same thing with equities. I mean, back for many years, we had more than the net worth of Berkshire in equity positions, but they were cheap.
And I want you to remember one of my favorite sayings as you do this asset allocation. If a thing's not worth it doing at all, it's not worth doing well.
Yeah. You can see why Ben Franklin turned the mantle over to Charlie.